rolling now. My name is Michael Schumann, and I am a publisher and writer of the Main Street Journal, which is one of the sponsors of this webinar series called Community Capital Live. And I'm pinch hitting moderation today for Joel Skeen, who runs a radio series called The Mindful Marketplace. The goal of our series is really to share community capital innovations, particularly those that promote local ownership and are helpful to distressed communities. Um, Hopefully, our offerings inspire you to do some of these things in your own community. And I guess we embrace the principle of BIMBY, to begin in my backyard. So what you hear, steal and use for your own work. And today we are delighted to have a terrific guest who I will give a longer introduction to in a minute. But he is a guest who not only will share what he has to offer, but is also one of those people who is for hire to help your community do what he does. And I think many of you will want to do so when we are done. I'll just say a few other words about the Mindful Marketplace. We are co-sponsored by Neighborhood Economics, which is headquartered in Asheville. So my colleagues there, they're still recovering from the hurricane, so that's why they're not here today. We also are co-sponsored by Impact Alpha and the American Independent Business Alliance. Jen is our executive director. And today, our focus is going to be on a company called Chicago Trend. Chicago Trend was founded in 2016, and it's all about accelerating commercial development in urban neighborhoods with a particular focus on inclusively owned shopping centers. Currently, at least by its website, they own 5 shopping centers. They have mobilized 300 investors, some grassroots, some deep pocket, to make these things possible. And we are very privileged today to talk with Lyneir Richardson. Lyneir is the CEO of Chicago Trend. And I have a very long CV for Lyneir, which I'm not going to read,
Right,
but I
thank you.
just will tell you a couple highlights. First of all, I met Lyneir through a woman who I had talked to my business classes named DT Ogilvy, and DT is uh, a was really an architect of Rochester, New York, going in a really different kind of direction with its economic development. And she said, "You've got to talk to Lyneir about the creative stuff that he has done with real estate." But Lyneir and NDT were both in Rutgers. Now Lyneir is there, and he is teaching at the business school there, if I understand correctly, which
That's
I
correct.
do as well, a little bit north in New York City. But he is a practitioner. He's been involved in the real estate world for decades. Um, and I feel like what he has done, the models that he has done about taking shopping centers and other commercial properties in distressed communities and transforming them into community-owned assets that really are powerful new generators of economic development is really a wonderful model that we do want to spread. So, Lyneir, I'm going to hand it over to you and thank you again for coming today.
Oh, thank you very much for having me. It's my pleasure to be here. This is passion work. I always tell people that I started my career as a bank lawyer, and every day, right around this time, I'd fall asleep at my desk. We were making, 100 million, $200 million loans to some big publicly traded company. It wasn't until I got an opportunity, it was a pro bono assignment for the bank, where the bank was making a $90,000 loan to a barber who was buying his building in the neighborhood on the west side of Chicago, not far from where I grew up, that the work had meaning, right? It was the same promissory note loan documents is the big deal, minus a couple zeros. But it was something about getting capital to people in the places that other people overlook or undervalue. It's, people say it's too hard. Oh, it's that became my passion work, and I left the bank shortly thereafter. So this is a labor of love. I tell people all the time, I wish that my mission, sometimes I'm trying to think about how to talk about this positively. I wish the Lord would have given me the ambition to be a billionaire and a mogul and create dynastic wealth, or had given me the charge to be a missionary and the vow of poverty. I'm in the middle. He gave me my charge to be in the middle. And it's hard, right? Where I'm trying to do good and feed my family. I still like nice things. But I really want to, work in communities and democratize ownership and do these crazy things that, uh, you know, I think I hope I'll get my reward in heaven. That's probably the easiest way to say it. I want to spend, if I can, I put a little presentation deck together about our work, about the work at Chicago Trend. And I want to just share that with you. Let me see if I can share the slides. Give me 1 second. Let's see if I can make sure that's the right thing. I should know Zoom back and forth by now. All right. New slideshow.
There we go.
Slideshow from beginning. Great. Oh, no, wrong thing. I clicked the wrong button. That's tomorrow. Sorry. Is this it? Stop sharing. It's a quick summary of our work at Chicago Trend. Oh, there it is. And slideshow. Why is it? Stop share. Wait, oh, there it is. Slideshow from beginning. Still the right thing. Oh, sorry. There it is. Open. Am I sharing or not sharing? Can you see this?
It's kind of coming on and off.
Okay. 1 more second. If not, I'll do it. Am I on now? Can you see that? It's still not the right document.
It's in sort of your computer mode.
All right, give me 1 second. I got 50 things open there. Maybe that's the problem. All right. 1 more minute. Sorry about this. Slideshow from beginning. Share the slide. After 4 years, I should be an expert in Zoom. There it is. All right. So, I'm going to tell you a little bit about our work at Chicago Trend. We own shopping centers now. We own 6 of them. And the thesis of the work is not about the shopping center. In fact, when I tell you our origin story, you'll understand why. It's just that these are assets that can drive change in communities, create opportunities for individuals, and we figured out a way to get impact investors involved in the work. We started Chicago Trend in 2016. Initially, it was a research assignment. As Michael mentioned, I am on the faculty at Rutgers Business School, and I was initially engaged as a consultant to the MacArthur Foundation to help them come up with strategies around how do you revitalize commercial corridors. As you know, and as we researched and sort of concluded, commercial corridors are your first impression of a neighborhood. If they're blighted or disinvested, they could attract crime, they bring down property values. And initially the work was, could we put together a strategy that would help, revitalize commercial corridors? And, MacArthur said, so many people come to us, they want to sit down restaurant or a coffee shop. They're asking us for a planning grant. We don't really care about retail. We care about making neighborhoods better. And so, we, after 2 years of a research assignment, they said, why don't you do it? They loaned us $5 million at 1% and said, go prove up your strategy. What a great way to start a business. Right after COVID, we started acquiring shopping centers, and we buy them, I call them in communities that are low and moderate income, and we create opportunities for low and moderate income individuals to acquire them. We're now working on our next project, which will be in Philadelphia. Our motto is we'll identify a property, we'll do the due diligence, we'll do the financial underwriting, determining how much debt is needed, determine it's something that we want to own, that we think we could earn a return. And for a period of 90 days, we go out and we do meetings in church basements, in apartment building common areas, in the public library. I joke, when's the last time someone knocked on your door and said you want to own something in your neighborhood? And we figured out how to structure that possibility to be able to happen. As Michael said, I mentioned earlier, this is passion work. And so, I lead this Chicago Trend Social Enterprise and Fund. I'm assistant professor at Rutgers. I've had a long career in economic development. After leaving that bank job many years ago, I headed economic development in Newark, New Jersey when Cory Booker was mayor. I was a vice president of a national real estate company, and we did projects in Baltimore and Birmingham and Dallas and Detroit, all over the country. Most recently, I've been writing. I'll tell you about the work with Brookings and an Aspen fellow as well. I built a team, that does this work, so I get to talk about it and be a CEO. But a competent team over the years, that are people that have had, big backgrounds at Jones Lang LaSalle and JP Morgan Chase and folks at real estate companies. Bill Little used to run the housing authority in Chicago. Michelle does our community organizing work. So we really do have a team that does the work. We decided what we would buy. As I mentioned, we buy intentionally in majority African American communities. That's our little niche. We buy urban density. We believe, neighborhoods are on the cusp of change always. So is it about to gentrify? And we make the argument that we'd like to have local people have an ownership stake in a neighborhood that's gentrifying, not always protesting and fighting gentrification, but being in a power seat to benefit from it. Or neighborhoods that are about to decline. The shopping center we bought about 18 months ago, about 9 months before we bought it, 5 young people were shot in the parking lot. Right? And this was a place that people loved 50 years ago, and it had declined. And so the city was like, if you can do something there, we will support you. And we got a boatload of grant dollars and a lot of community investor participation because they wanted to see this shopping center not bring the neighborhood down. We buy fundamentals of good real estate: visibility, access, and parking. Our tenants, and when I say shopping centers, people think of the mall. What we own is not the mall. We buy the neighborhood strip center. Right? It's the place where you go to get a carry-out pizza or chicken or your hair salon. 30% of our tenants are healthcare, urgent care, MRI, eye doctor, ear doctor, Athletico, which is physical therapy, FQHC, and we like the healthcare tenants. They make improvements, they stay a long time, they bring traffic, they're great tenants. So in the shopping centers we own, this may be changing in a while. They're service centers, UPS stores and things of that sort. So this is neighborhood service centers that even during the worst part of COVID, the entrepreneurs figured out how to come in. They weren't quote unquote essential businesses, but people still came in and ordered their pizza, or the entrepreneurs quickly figured out, if they were doing manicures, how to put glass, partitions in between each seat and open up. And then we buy. This is the reason why I like acquiring the shopping centers, is we buy based on some metric of existing income, 8% of existing cap rate, right? 8 cap rate is what we talk about. So we know we can pay the mortgage and taxes while we look for an opportunity to add value to improve the shopping centers. and petition government for subsidies to the extent that they're available. We own 6 shopping centers now. Each one of these we proved something different. The first one we bought, we hired a Black property manager who said, "I managed residential forever. No one ever gave me a chance to manage commercial." It's a small 20,000 square foot center. This store you see is some Sean Michelle's ice cream. Michelle Obama came and tweeted best ice cream she had of this at Sean Michelle's. The second project we had a UPS store franchise where we helped them open. There's one vacancy there. We loaned the entrepreneur some money, gave them free rent, connected them with the UPS store franchise. This was a corporate guy who wanted to be entrepreneur. The third one, we invited one of the business owners to be an equity holders. The first time we had a business owner in. The fourth and fifth, we invited community members. We now have over 330 who've invested in each one of the properties. I'll tell you about it. And the fourth is right across from a hospital. It's Roseland Medical and Retail Center. It's FQHC as well as food services and things that benefit from the hospital. When I talk about using a fintech tool, and that's what I call small change, a fintech tool meets community organizing. So, our offerings get registered with the Securities and Exchange Commission. And we post everything about it. Here's who we are. Here's who I am. Here's the development strategy. Here's the rent roll. Here's what we think the financial returns will be. And we put that all on this platform. I had one senior citizen once tell me at a community meeting, "Baby, I printed out your offering. It's 92 pages. I never actually printed it out." The reason why we like this is all the information's there. We do our investor reporting here. You can click on the, it's offering closed if the offering is open, and you can make your investment right on the site. The site is just a vehicle. As I said, in each one of these offerings, I've done more than 40 Zoom calls, in-person meetings, Saturday morning. One Saturday morning, I was out in the parking lot in one of the sites that we were about to buy, and I kind of felt like I wish I'd have brought lemonade. It felt like a lemonade stand, and I was telling people, here's what we're doing here's what ownership means. And our thesis is that if people have a little ownership stake, they'll patronize and protect and respect it in a different way. So our inclusive ownership model now has 380 investors. 67% are Black, 46% are women, as you see, and 53% reside in low and moderate income neighborhoods. Intentionally inclusive doesn't mean exclusive. So 33% of our investors are non-Black. And, 47% don't reside in low and moderate. We have investors as far away as Australia. People invest with us because they want to earn a return. We project we can earn a return of 12% or maybe 15% if we're really right. But people invest where they want to earn a return, but they also want to feel the benefit of supporting positive community development. Neighbors want to talk about community cohesion, feel community cohesion. We branded this thing, and I got rings around. If you were with me, I got rings all over the place where we call it hashtag we own this, right? So the little we own this, we tell you married to the movement if I put a ring on your finger. The purpose of the hashtag is that the theory is not even just about the 380 people that invested. What we try to think about is an ethos or a mindset of ownership. This is an on-ramp to ownership. If someone invests, our smallest average investor is $2,270. That means a lot of people invest $1,000. Even if we're remarkably successful, they're gonna make $5,000, $6,000, $7,000. So it's not gonna change anybody's life financially. Except when I wanted community investment, I didn't want it to be just about a nonprofit. I wanted to know some individuals had actually benefited. But even more important, it's an on-ramp to investment, that people for the first time, if I was going to have coffee, I'd say, "Hey, Kimberly, let's have coffee at the shopping center that I own." Or I want my kids or my church member or my fraternity brother, to feel this connection. So it's not just about the 380 people, it's an extension of them that people will say, "I know someone that owns that." Think about the shopping center near you. You know who owns it? You know anybody that owns it? You know who manages it or leases it? And if you're in a community of color, you certainly don't know anybody of color that is in those leadership roles. So that's what the we own this mantra that we built is, and we're building is about, our goal is to get to 1,000 community investors because commercial real estate ownership matters. This work came out of, the COVID, pandemic, the right after the murder of George Floyd, and everyone making these big announcements about closing the racial wealth gap. Well, wealth is created by owning assets, assets that generate revenue, assets that appreciate over time, have tax advantages. So if you're going to close the racial wealth gap, you got to help people own assets. That's clearly homes, businesses, stock. We have a strategy around commercial real estate. In my work at Brookings, we've, this statistic, less than 1% of households own 81% of commercial real estate. It's not hard to believe, but the question is, what if you democratize owners? And in ownership, you can hire the professionals and support small business owners and decide how the property will be managed. We're meticulous, maniacal about cutting grass and picking up trash just because we want people to feel like somebody cares in a different way, even in a low income, formerly blighted, shopping center. We believe we can change neighborhoods. We're measuring stuff like, will crime decrease? Will property values increase? And typically what that means is gentrification. But in the neighborhoods we're saying is like, can we achieve, amenities and services in neighborhoods? We're not bringing in Cheesecake Factory and Nordstrom's, but, can you have better services and amenities that will, be for and, benefit the people in the neighborhood? As we're making these things, we're doing climate positive improvements, and we've gotten some grant dollars to put solar panels on. And so that's been fun. And then finally, we formed a fund. Our fund has impact investors. The MacArthur Foundation, the Pritzker Traube Foundation, Kresge. So while our community investors have invested on average $2,000 or $2,200, these investors have invested, although the sisters of St. Joseph, the nuns have some money. Who knew? Maybe everybody else knew, but the nuns have invested with us, and we have a couple of religious organizations that have invested a couple $100,000. But these folks have invested on average, $2 million. So I'll stop there. So I just wanted to give you an overview of the work. The deity is always in the details, right? This is, sort of, hard work. The cool thing is Brookings, I've been able to write a playbook. If you put a little, send me a little note on LinkedIn or a note in the chat, I'll send you a copy of the playbook. Robert Wood Johnson allowed us to, sort of compensated us to write it and to share it. It's like an instruction manual. And so, we share that very readily. If folks are trying to do the work, and as Michael said, they, want advice or help, we're working, with from a community like Selma, Alabama, to I'm in Rochester tomorrow, of helping people implement the strategies and do the detail work, on a consulting basis, typically over a year's period of time.
So that's terrific, Lyneir. Just a couple of questions, and then I'll throw it to others who are gathered here, who I'm sure have
Yes.
lots of questions as well.
Yes.
Do you have a set structure for each of these shopping centers, like the set legal structure and set structure of, what the partnership and what the ownership looks like, or do you reinvent it for each project depending on, what the particulars are?
The only thing that's different, flash this really quick, and this is a recent chart we did of a project. So, we have, this was our last this was the project I mentioned where the youth were shot, right? So Chicago Training Corporation is the for-profit entity, and we are, we provide capital to this general partnership. The general partnership puts in 2.5% of the capital into the fund. The fund investors, Kresge, McKnight, those folks you said, put in 90%. That's the real estate fund. When we identify a property, the real estate fund can invest as little as 51% and as much as 95%. It just depends on how much the community people decide they want to invest. So part of the strategy is not to be desperate. Not like, if you don't invest in this, David, we're not going to buy it. We're not giving you a t-shirt. It really is, this is an opportunity. You're investing in, one of our investors is the Pritzker Traube Foundation. I often say you're investing alongside of the former U.S. Commerce Secretary. Right? So you know, and so this last project, what happened is I think it required $4 million of equity to complete the acquisition. The community investors invested $454,000, and Trend and our Trend fund invested 3.5 or whatever it is $1 million. And so the equity holder in this, so it's very clear. It's like, hey, need $4 million. If the community would have invested 2 million, they would own 50%. We would own. So we have some projects where the community actually owns 50%. But this is the essential nature of the structure that we try not to change. Again, the ownership percentage will change, the name of the asset will change, the individuals in the community investment vehicle will change, but the basic structure is the same.
So as these projects mature and they look like they're quite successful, do you want to sell your own shares so that you can put that capital to work in other communities, or do you want to keep a little finger in each
Yeah,
of these projects in perpetuity?
yeah, it's a great question. So um, I think there's a couple of answers there. So um, A, when we raise capital here, we tell people this we're long-term holders. Right? Certainly 7 years, probably 12 years, typical sort of fund economics. People will get a distribution based on cash available. Ideally, if we add some value, like we're about to announce a new grocery store lease, that's going to add some value to the shopping center that we bought. You can refinance and maybe pull some cash out, right? That's how you get your equity back initially. But then ultimately, at some point, we're going to exit. You got to sell to the next buyer. And in this period of ownership, every day, both even in the leasing of the shopping centers, but even as we think about the exit, there's this tension of mission, of market opportunity, or market demand, and money, right? And so, even when we exit, we're starting to think about, well, can we find another CDFI partner or community development partner that might, take our role? The dream scenario, we haven't got to planning it, so I always say it's dream because we've not done any work on it, but we've sort of been reading about, could we form a REIT, and could our community investors sell like 90%? Right now, when people invest, they own an interest in this shopping center in their neighborhood. So our dream scenario is, what if we put them all together, right? And then we could get some other capital that's not from the community, and you'd sell 80% or 90%. So you've gotten your financial return, but you still haven't, 10% or 5% or 20% ownership there. It's dreamy stuff, right? But that's where we are. It typically takes 2-3 years to stabilize, and you get in there, you implement. And then, it's that year 3 to 4, which we're just coming on. Our first shopping center we bought in April of 2021, even April 2020, right after COVID, right? So, people are like, oh man, you bought a shopping center after COVID. How's it going to, but again, given the nature of this work, that's why we bought the second one and the third. We're like, hey, this works, right? People are, our retailers are open, and, these services, are needed as well.
So let's talk about the fund. I'm interested, does the fund only accept investment from these large foundations or accredited investors, or can grassroots investors put money in the fund side of it as well?
Right. So the fund is accredited investors. And quite honestly, they're what I would call philanthropically motivated impact investors. They're taking
Right.
less return to incentivize this local ownership. That's why they're mostly foundations. It's been
Hmm.
hard to raise that money, right? For every, you hear people talk impact investor, impact investor. For every impact first investor, there must be certainly 10, maybe 100 finance first investors that say, look, if you can give me a double-digit return, I'm interested. But the investors in our fund are either wealth holders. They don't have to be foundations. As I said, I mentioned the sisters. There's a couple private offices that have said, hey, if you can get me a 5% preferred return, an 8% target return, and that'll allow you to give the community investors a 12 or 15% return, I'm willing to do that, right? And so we had to create the fund economics, and raising a fund like that. We spent $300,000-400,000 of legal fees, consulting fees, advisory fees. You got the accounting and financial reporting is even though it's a you wanted, that's why people want big funds, because you have all of this, administration associated with it. So right now, as I said, the community or the individual investors, it said average is $2,200 invest on a project by project basis. So it really is the community investors hyper local, right? You know the property, or you sort of know our work and you say, boy, this is another one of those things that's fun. I want to, as I said, people live in, you mentioned Kevin at Neighborhood Economics. Kevin lives uh, in North Carolina in Ashbrook, but he invested in our project, and his family invested in our project in Baltimore, right? Because so you don't have on the community investors, you don't have to be accredited. That's the whole regulation CF, the crowdfunding platform. Anyone over the age of 18 with $500 or $1,000 can invest, but the fund requires you to be an accredited investor. And we're trying to get a minimum of $250,000. So we're starting to talk to, like when I'm meeting people of wealth, I'm now saying, you have a DAF, you have your strategy where you want to incentivize community development and in the work that we're doing, and trying to identify more of those people as well.
So I happen to know that one person on this call is an investor in one of your properties, and I know
good.
this because she's my wife.
Okay, good.
So, Audrey, why did you invest in Lyneir?
Hi, Audrey. Thank you.
You are muted there.
All right. So, yeah. So early on, when you all were looking at Baltimore, Michael was working with the Baltimore Neighborhood Exchange. Was it called?
Yeah.
Baltimore Neighborhood Exchange. And I had just set up a solo 401k. I was trying to start, launch myself as a freelance business person. And so I moved some, and we had gotten married, and I thought, I believe in this. I'm going to do what he says I should do. I'm going to move 1% of my money from Main Street, Wall Street to Main Street. And so I moved, I had an IRA and moved some money into my solo 401k, because while I was trying to start up as a freelance writer, of course, I wasn't earning very much, nothing. So, but then I thought, okay, so now what do I do? And it's a challenge to find things to invest in. But then he was working with the Baltimore Neighborhood Exchange, and this was on there. And I'll tell you, I invested in some other projects on the Baltimore Neighborhood Exchange, but none of them met their target. But yours, I invested in, and before I knew it, it was closed because you raised your capital. And when I saw your proposal on there, I thought, okay, I get this. This is someone who knows real estate, who's obviously investing in at-risk communities. I liked that part of it as well. And this is not going to lose money, right? Everybody understands real estate. You don't always understand stocks and bonds, but you're like, okay, it's good commercial property. They're going to bring it up to, renovate it, whatever it needs to be done to make it viable. And this will be a real service to the community. So it just made sense to me. And I kind of wish I had invested more. I think I was your $1,000.
Look, Michael, I gotta have a copy of this video. You're gonna be my commercial now. Thank you. Who knew? Thank you for that. That's as we said, as hard as the work is,
right.
Validating stories like that. And we're still in the, we're still working, right? None of us have, gotten rich yet, but we're in the middle of it. And the good thing about this, you can see it, it's still open, where your money is, and you can come grab a pizza, or go to the Chinese food place, or go to the the grocery store that's in the shopping center. So yes.
Except we moved to California.
Oh.
So I come to Baltimore. I need to try to visit though. And I do have one question, because I also participated in, I guess, a research project. There were some researchers that were.
Thank you. Yes.
Yeah, and I participated, and I thought, they really need to speak with Michael. But they wanted to know, they were asking, like, what kind of businesses would I want to go in there? And I'm like, I'm not really in the neighborhoods. Right. I don't know. But I was telling the service industries. And one thing that came up is I was wondering if the community has any buy-in or say so as to what businesses can rent there. Because I was thinking, gee, I hope that, there's pizza and nails, or the health services or whatever. And that's kind of like what I thought you were aiming for, and what I hope you've achieved.
Yeah.
But I didn't want a package store to be in there.
Correct.
And nothing against package stores. I
Yep.
like my martini occasionally, but
Martini in a brown paper bag. Okay,
right.
Audrey.
But,
I see why you moved to California,
I mean, people need to enjoy life,
Yeah,
and they
yeah,
need to,
yeah.
alcohol is a nice form of entertainment as well. But in many depressed communities, it seems like that's the only business that ends up surviving. So
Yeah.
how do you manage to kind of avoid that and
Yep.
make space for other businesses to thrive? Do you keep their rents
Yeah.
low, or do you screen them?
No, so you got like 4 questions in there. Let me try to hit 2 or 3 of them. So first of all, as I mentioned, every day the tension of mission and market demand and money comes up, right? So, while we celebrate the Black-owned ice cream store, um, you know, in the wintertime, we have to, they don't pay their rent on time, right? Or, you got to figure out how to, be patient. Um, the liquor store would pay their rent on time and would pay rent above market. Right? But that's not our mission, right? We had a vacant space in the shopping center you invested in, Audrey, and you had an opportunity there's a check cashing place there. We had an opportunity to get the check cashing place out. Check cashing is almost by definition extractive. There's one Black-owned bank in Baltimore. They came and visited. We had sent them an LOI. It'd be the economic development story of the year. They placed a check cashing store with a Black-owned bank. And ultimately, the bank's board of directors turned it down, right? But it was that kind of thing where, we started saying, how long can we keep this space open, right? And vacant, not revenue generating. But there's some things, that, we have to do some things we don't want to do. And so our mission, money, market demand, market tension, we play out every day, right? Because we're a social enterprise, the mission of our company, I'm now on this, we've now owned these centers for 4 years. We haven't rented to a package store. We haven't rented to check cashing. We haven't rented to blood plasma. We haven't rented to, rent a, what you would define as classic sort of extractive tenants. Will we never? I never say never. That's not our mission. That's A. B, the community members here have voice. Right? So, unless you're, I personally guarantee these loans. So my house is on the line. So that decision about how do you ultimately decide what goes in and when, that's why these initial investments, I do these Zoom calls so people know who you're dealing with. They're investing in, the project sponsor, the entrepreneur, and, they're going to make, good calls. But every community investment vehicle could be different, right? There are various models. Some are about community control. Some are about preserving affordability for the small business owners. Our model is about, can you make this property an asset that will increase values in the community, and can people earn a financial return, right? And so you need both, right? If it's just financial return, you rent to the blood plasma center and have, them pay above market rent. And if it's, but it's the dual mission of our success is measures. Did the community get stronger? Did the commercial corridor get better? We're looking at things now about, what's happening across the street. Can we help them find grant dollars to support commercial corridor development activities? When our tenants struggle, we've now gotten some grant dollars to be able to provide marketing support for them. So, that is, it's again, it's all the nuances of the details of the work and all these tensions, and, our asset managers in Baltimore sort of have a handle on that. And as you know, we send out, periodic reports. We do an annual meeting. We're looking forward to an in-person meeting, with whatever if there are 300, 130 people in the one property, maybe 30 or 50 will come out to actually, because they live nearby, they live in the area, and others won't, right? As I said, people invested because, like you, Audrey, I want to support the work. It's, I want to be mission oriented, but I don't know if it should be FQHC in there as a good tenant, or a grocery store, right? People don't know what or a coffee shop, right? So part of that is, you know, the localism component of it, as well as the impact investor component of it as well.
Great. Anyone else have questions for Lyneir?
Yeah.
Yes, David.
So I have a list of questions. So I'm going to
Please go for it.
I'm going to just keep it to a couple. Have you used community development financial institutions in this process as part funders of local projects?
Yes, in the first, in 4 of 6 or 3 of 5, we own 6 now. 3 of 5, 3 of 6 are financed by community development financial institutions. One has the project that Audrey invested in Baltimore has 2 CDFIs. The loan was like $6 million, and each one did $3 million loan. You know, maybe it's 3.2 million. I don't know exactly the amount, but it was like, you know, we borrowed, I think it was 5.5 or $6 million, and each did half of it, whatever the number is. We like CDFIs. I should say we have a love-hate relationship with CDFIs. It's like borrowing money for your grandmother. They're a little slower. They're gonna do it. They're gonna ultimately do it, but you got to take the long conversation and the lecture and you got to go eat spaghetti with them and all that stuff, right? But they're gonna do it. The hope is that they won't break your kneecaps if something goes wrong. They're a little more patient, and it takes a little longer to get done. And so some of the hate part of the CDFI is, the seller wants to close, and now the CDFIs, I think I advocate for them of needing more funding for staff and grants so they can, have, more, ability to move faster and not feel like your grandmother. But on the other hand, they've given us higher loan to value ratio, so we don't need as much equity. They're, more flexible in the payment terms. Maybe it's interest only for the first year, so, there are advantages, right? And so, yes, of the 6 properties we own, 3 of them, I think it's 4, but 3 of them I know for sure are financed by CDFIs.
Okay, and so I think the second question is maybe simple or more complex. Do you ever marry cooperative enterprise with an investment like this, with a real estate, basically a real estate investment?
Yeah. So for us, no.
No.
Here's the reason why. This work, and I've seen it, Audrey sort of alluded to it, some others didn't get to the finish line. This community ownership, community investment vehicles, investing local, it's one of those things that's cool to talk about at a cocktail party. Right? Yeah, I invested in it. The challenge is people, when they complicate, like we try to figure out how to simplify it so you understood we're buying on an ACAP, it's hard real estate, you're a member, $4 million equity required, you invested $10,000, you invested $4,000, you got whatever, 1% of the ownership, whatever, I mean, numbers right, $40,000, I got 1% of the ownership, right? So you understand what it means. There are all these things. I said there are many models, co-ops, as in people that want to preserve affordability, all about voice, all about control. So for us, we just wanted something that was as hard as it is, I'm talking about simple to execute. Audrey understands it, right? It wasn't like you need to be and now it's not as cool for her to talk about, that I invested in this co-op, this in this community investment vehicle, that's about, she didn't have all those bells and whistles, right? In terms of cocktail party, cool. But hopefully, she'll have the impact measure. This thing was a problem. I invested my whatever, $5,000, $1,000, $10,000, and it's gotten better, and I got a return, and I'm happy. And it was 60% of local residents and low-income people also got a return. Right? That's what we're hoping people will celebrate. That's not to denigrate other models, right? Or we've tried to figure out what can we get done. And, we've now owned 6. We've done 3 of these community crowdfunding campaigns. We're about to do our fourth. We're trying to get to 1,000 people. Imagine if 1,000 people patronized, protected, and respected, an asset in their community in a different way because they imagine if their kids say, my family owns that, yeah, we don't talk about people as, as limited partners. I went to this conference once before he got ill. Jesse Jackson spoke, and he said he went to a meeting at Microsoft, and he said, our organization had bought 100 shares, but I was standing next to Bill Gates, who owned, 1 million shares or 100 million shares. And he said, what I realized is that we were both shareholders. And so that's how we think about it. If you can invest $1,000, nobody know. I don't even know what Audrey invests. I can find out, but she's the owner, right? She's a co-owner with us. And someone may have invested, Kimberly may have invested $100,000. We have at least one of the projects where someone did invest 30 or 50 or $100,000. They both, just like us, are co-owners.
All right, we maybe have time for one more quick question. Anyone who hasn't spoken want to throw one on the floor?
And I'll see if I can find the playbook while you're doing that. Just I'm gonna Google real quick and try to put the link in the chat for folks.
Yes, David.
I'm curious what's next. Are you doing more crowdfunding? And if I was looking at the Small Change website, is that how to find out about future offerings?
Yes. So let me just find this bookies thing real quick. So as I mentioned, we just have reached agreement to acquire a shopping center in Philadelphia. We're going to spend probably the next 2 months doing the due diligence, assuming it all, passes the due diligence, and we can arrange, put the whole puzzle. It's a puzzle to put together, right? The puzzle of the financing. How will the city support? Are the tenants going to stay? Who do we want to go? Can we get new tenant commitments? The offering will be available, you'll call it February, March. It available on Small Change. We have been good about making some noise about it. We got good, press. We try to, in every community. So I'm gonna, ask Michael when we do it when we're ready to just share it with his community as well, just so you get to see it. The cool thing is you read it all, and you can do your own analysis and decide, hey, this makes sense, and you invest. And we welcome you to be a co-owner with us. I'll give you a ring. I got my We Own This ring. I'll save it for you, David.
No, when so in Lyneir, in our Main Street Journal Extra edition, we carry listings of things like this, and so yeah, we will do what we can to let people know about this. Well, we've reached the end of our time, and I really want to thank Lyneir. Please join me in giving a quiet round of applause to the brilliant work that he's doing. And let me just say that if you're interested, our next two Community Capital Live events, one is with the Kensington Corridor Trust in Philadelphia on December the 4th, and the next one is with the Rudolf Steiner Social Finance Fund on December the 18th. So if you are a subscriber to the Main Street Journal, you will get regular pushes about these events, and hope you can join us. And again, thank you again, Lyneir. Thank you for the rest for coming and joining us. And we look forward to seeing you all again.
Thank you all again. Thank you. Good day.
Thank you.